Hi, welcome back to the channel. In today's episode, I want to talk about something really interesting that's currently happening in the US economy, because artificial intelligence may be starting to cause a problem that I don't think many people saw coming. And strangely enough, the problem isn't necessarily in the stock market. We're not talking about Nvidia or an AI bubble, and it isn't even whether companies such as OpenAI eventually make enough money to justify all of the billions currently being invested into artificial intelligence. The problem is the bond market, because the artificial intelligence boom requires an absolutely extraordinary amount of money. We're talking about hundreds of billions of dollars being spent building data centers, buying chips, securing electricity supplies, and creating the infrastructure needed to power this new technology. And increasingly, the big technology companies are borrowing that money at exactly the same time that the United States government is also trying to borrow an absolutely enormous amount of money. And that means something very interesting is starting to happen. The US government and some of the biggest and most profitable companies in America are increasingly competing for the same pool of investors. And that matters because if investors have more attractive alternatives to US government bonds, the Treasury may ultimately have to offer a higher return to persuade people to lend it money. That means higher Treasury yields, higher borrowing costs for the US government, potentially higher mortgage rates, higher corporate borrowing costs, and ultimately a higher cost of money across the whole American economy. So in this video, we're going to go through some really interesting numbers and graphs which show exactly what's happening. And for those of you who've been missing the graphs recently, don't worry, there are plenty of them today. Before we get into all of that, can I ask anyone that hasn't subscribed yet to please hit that big red subscriber button? It doesn't cost you anything, it's not really a subscription, it just shows that you quite like this channel. Could you also give me a thumbs up? And if you have the option of hitting that hype symbol, the funny little thing that looks a bit like a tadpole, please do that because it will promote this video to more people and put a smile on my face. Now let's start with the scale of what's happening in the US corporate bond market. This graph comes from SIFMA and shows US corporate bond issuance. And the important thing here isn't necessarily any individual month, it's the sheer amount of debt now being issued. Through July 2026, US companies had already issued around 1.68 trillion of corporate bonds. That's around 27% higher than the same period in 2025. So we're not talking about a small increase here, we're talking about hundreds of billions of dollars of additional borrowing entering the market. And one of the major forces behind that increase is artificial intelligence. Historically, the biggest American technology companies have been in an almost ridiculously strong financial position. Companies like Microsoft, Alphabet, Amazon, and Meta generate huge amounts of cash. Some of them accumulated enormous cash balances. They weren't companies that were desperately needing to borrow money just to keep themselves alive. But artificial intelligence is changing the economics because building AI infrastructure is incredibly expensive. And that brings us to the second graph. This comes from the Bank of England's Financial Stability Report. And this is probably the most important AI graph in this whole video. The Bank of England has grouped together 5 of the biggest AI hyperscalers, which are Meta, Alphabet, Amazon, Microsoft, and Oracle. And what this graph shows is the amount of investment-grade bonds those companies have been issuing. If we have a look at what happened in 2025, the amount jumped dramatically. And if we then look at 2026, we're only partway through the year and issuance has already exceeded the whole of last year. That is extraordinary. And the really interesting point is the sheer scale of those companies as borrowers. The Bank of England says that across all currencies, investment-grade bond issuance from these major AI hyperscalers has become comparable in scale to the borrowing requirements of governments. And estimates suggest that around $240 billion of hyperscaler investment requirements in 2026 could potentially be financed through investment-grade bonds. For comparison, America's 6 biggest banks would normally issue something like 150 to 170 billion of senior debt in an entire year. So AI companies are becoming some of the biggest borrowers in the financial system. And the reason this matters is very simple. Every borrower needs a lender. Every bond that gets issued needs somebody willing to buy it. And those somebodies are pension funds, insurance companies, asset managers, banks, foreign investors, sovereign wealth funds. There may be trillions of dollars in global capital markets, but there isn't an infinite amount of money. And that brings us to the other enormous borrower competing for that money, the United States government. This graph shows total US government debt, and the number is now approaching $40 trillion, actually more than $40 trillion. The scale of the increase over the last decade is incredible. But there's something important here which I think often gets missed when talking about the national debt, because the US Treasury doesn't simply need to borrow enough money to cover this year's deficit. It also has to refinance enormous quantities of existing debt as that debt matures. And those are two completely separate demands for money. So let's start with the deficit. The Congressional Budget Office currently projects that the United States will run a federal deficit of around $1.9 trillion in 2026. That works out at an average of $160 billion of additional borrowing every month. Not to replace existing debt, this is new borrowing to cover the shortfall between spending and income, because the government is spending more than it receives in taxes, and the Treasury's latest estimates really demonstrate that scale. For the July to September quarter alone, the Treasury expects around $739 billion of net marketable borrowing. And for October to December, another $628 billion will be added. So across those 6 months alone, we're talking around $1.37 trillion of additional net borrowing. But that's only half the story, because America also has a gigantic refinancing machine running underneath all of this. When a Treasury security reaches maturity, the government has to repay the investor. But obviously Washington doesn't have hundreds of billions of dollars sitting around waiting to permanently pay down the national debt. So in practice, it issues another security. New debt replaces old debt. And Treasury's own financing figures demonstrate just how enormous that process has become. For the July to September quarter, the Treasury financing tables show around $1.1 trillion of gross coupon issuance. But around $721 billion of that is simply replacing coupon securities which mature during the quarter. That leaves around $367 billion of net new coupon issuance. And just think about that. In just 3 months, more than $700 billion of longer-term Treasury securities mature and need to be replaced. And Treasury is issuing more than $1 trillion of coupon securities during the quarter. Annualize that current pattern, and we're talking around $4.4 trillion of gross coupon issuance in the year. Of that, approximately $2.8 trillion represents existing coupon debt maturing and being refinanced. And even that isn't the whole Treasury market, because we haven't included Treasury bills. Bills mature in 1 year or less. Some mature in a matter of weeks. So billions and billions of dollars of short-term government debt are constantly being issued, maturing, and then being rolled over again. This means the bond market isn't simply being asked, can you lend America another $2 trillion this year? It's being asked, can you lend America money for the deficit and also continually refinance trillions of dollars of debt, which already has been issued? And this is where the interest burden becomes really important, because imagine that America issued a bond several years ago when interest rates were incredibly low. Perhaps that debt cost the government 1%, or it might have been 2%, or maybe as high as 3%. Eventually that bond matures and the Treasury now has to refinance it. But the replacement debt will cost 4% or 5% or potentially even more if you're issuing long-term money. So even if the national debt stopped growing tomorrow, the government's interest costs will continue rising simply because cheap old debt is gradually being replaced with more expensive new debt. But of course the debt isn't standing still. America is simultaneously adding around $2 trillion of new debt every year. And this helps explain why interest costs have become such an important part of the federal budget. CBO says rising net interest costs are one of the major drivers of America's projected increase in deficits over the next decade. And now, into this enormous market enters AI companies. They're not borrowing instead of the US government, they're borrowing at the same time as the US government, and that's the key point. And that brings us to the next graph. This shows government debt relative to the size of the US economy. And the latest figure here shows that it's sitting at around 123% of GDP. Before the pandemic, it was much lower. Obviously, the pandemic caused an enormous increase, but the important part is that the debt ratio didn't then go back to where we started before the pandemic. The US continues running substantial deficits. The CBO currently projects this year's deficit at around 5.8% of GDP. And over the next decade, it expects federal deficits to remain unusually large by historic standards. So Treasury supply isn't likely to disappear anytime soon. And now we come to the graph which I think makes the whole AI versus Treasury story particularly interesting. This chart is based on Yardley research analysis of US Treasury and LSEG data and was highlighted by Axios. And what it compares is the rolling 12-month net purchases of US corporate bonds by private foreign investors versus their purchases of Treasury notes and bonds. And look at the latest numbers. Foreign private investors have bought roughly 390 billion of US corporate bonds. Their purchases of US Treasury notes and bonds were around 329 billion. So over this period, foreign investors actually put more new money into corporate bonds than into long-term US government securities. Now I want to be really clear here, that doesn't mean investors are suddenly abandoning the US. It certainly doesn't mean that the Treasury market is about to collapse. The US Treasury market remains one of the deepest and most important financial markets on earth. And what it does demonstrate is competition. Imagine you're running a giant pension fund. You've got $1 billion which needs to be invested. And the US Treasury said, would you like to lend it to us? But then Microsoft comes along, and then Alphabet and Amazon, and they're offering attractive yields on highly rated corporate debt. Suddenly the Treasury isn't the only attractive option. And if the Treasury wants to make sure that investors continue buying enormous quantities of its debt, the price might have to adjust. And in bonds, price and yield move in the opposite direction. If investors aren't willing to pay as much for a bond, the yield it rises, which effectively means the government has to pay more to borrow. And this brings us to the next graph. This shows the US 10-year Treasury yield. And look at the transformation since the era of ultra-low interest rates. Back in 2020 and 2021, yields were around 1%. Today, we're talking around 4.6%. Now, clearly AI isn't solely responsible for this. Not even close. There are several enormous forces driving Treasury yields, such as inflation, Federal Reserve policy, government deficits, the supply of Treasury securities, concerns about America's fiscal trajectory, global capital flows. All of those things matter. But AI-related borrowing is now adding another source of demand for capital into that equation. And that's potentially important at the margin because the Treasury doesn't need investors to stop buying government bonds for yields to rise. It just needs investors to demand a slightly better return before buying them. And when you're borrowing and refinancing trillions of dollars, even a relatively small increase in the interest rate eventually becomes a very large amount of money. If the average cost of borrowing on 10 trillion of debt rises by just 1 percentage point, that's another 100 billion per year of interest that needs to be paid. And that's the mathematics of the problem. And then we get to the final yield graph. This is the 30-year Treasury yield, and this has recently been trading above 5%. For me, this is particularly interesting because it tells us something about the price investors demand to lend the United States government money for decades. And long-term Treasury yields matter far beyond Washington because Treasury bonds form the foundation of enormous parts of America's financial system. Mortgage rates are influenced by Treasury yields, corporate borrowing is priced relative to Treasury yields, commercial property finance is linked to it, infrastructure projects, car loans, business investment. Financial markets use the Treasury curve as a benchmark everywhere. So if America's cost of borrowing remains structurally higher, the cost of capital throughout the economy will also remain high. And the AI investment boom could be much larger than what we've already seen. The Bank of England points out that expectations for AI capital expenditure have been revised dramatically higher. At the end of last year, consensus estimates suggested capital expenditure by the major hyperscalers in 2028 would be around $600 billion. Those expectations have since risen to more than $1 trillion. So this might not be a one-year borrowing frenzy. We could be at the beginning of a multi-year capital raising cycle. And the bank estimates that more than half of the external financing needed for global data center investment between 2026 and 2028 could potentially come from debt. So ask yourself the obvious question, where does all of this money come from? The US government needs money, corporate America needs money, consumers need mortgages, businesses need loans, infrastructure needs to be financed, and now AI companies potentially need hundreds of billions, eventually trillions of dollars as well. Now, capital isn't unlimited, and the price of capital is effectively the interest rate. When everybody wants more capital at the same time, usually the price goes up. There is also another risk underneath all of this. The Bank of England points out that free cash flow at some of these big AI hyperscalers is declining as capital expenditure rises. That doesn't mean those businesses are financially weak. Most of them remain extraordinarily profitable companies with strong balance sheets and high credit ratings. But it does mean the economics of the technology sector are changing. Some of America's biggest cash generating companies are increasingly becoming enormous consumers of capital, and some of the things they're financing have potential short economic lives. A data center building may last for decades, but the chips inside that building can become obsolete extremely quickly. Technology moves very fast. So in some cases, you can potentially have long-term financing being used to buy technology which needs replacing after only a few years. And that's one reason why financial regulators are starting to pay attention. None of this means the AI boom is about to collapse, and it certainly doesn't mean that US Treasury bonds are going to fall apart, but it does highlight what I think is a fascinating unintended consequence of artificial intelligence. For decades, some of Silicon Valley's biggest companies were enormous generators of cash. Now they're becoming enormous consumers of capital, and they're entering global debt markets at precisely the same moment that Washington itself has an extraordinary financing requirement. America is running a deficit of almost $2 trillion per year. It's refinancing trillions of dollars of existing debt. The Treasury is issuing more than $1 trillion of coupon securities in a single quarter. And the AI companies are simultaneously asking investors for hundreds of billions of dollars themselves. So when people talk about the artificial intelligence revolution, we normally hear about NVIDIA chips, productivity, job losses, chatbots, data centers, and soaring technology shares. But one of the biggest impacts of AI could ultimately turn up somewhere completely different: the bond market. Because if artificial intelligence keeps absorbing hundreds of billions of dollars of investment capital, while the United States government keeps borrowing and refinancing trillions, two of those enormous forces are going to collide more and more frequently. And if that competition helps keep long-term Treasury yields even slightly higher than they otherwise would have been, the complications are enormous, because AI then isn't simply changing technology, it's potentially changing the cost of money. And once you change the cost of money, you change virtually everything in the whole of the US economy. So hopefully you found today's video useful, informative, and most importantly, thought-provoking. If you've liked what I've said, or maybe didn't like it but you thought it was interesting, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. If you have the option, you can see that funny little hype symbol. Please hit that because it will help promote this video to more people. Thank you so much for watching this video all the way through to the end, and thank you so much to everyone supporting me. If you bought me a coffee or sent me a YouTube super thanks, that is amazing. Thank you. Really appreciate that generosity. And if you've signed up as a long-term supporter, either through YouTube membership or Patreon, thank you so much. That's the thing that keeps me focused and trying to come up with more interesting ideas for videos. Hopefully you've enjoyed this one. Thank you so much, and I'll see you again next time.